traders and investors. Bennett Tyndall, tradinganalysis.com. It's Tuesday, March 23rd, 2021. If you're interested in staying up to date with myself and the rest of the Trading Analysis team, don't forget to subscribe and turn on notifications. Today I wanted to do something a little bit different, and I wanted to walk you through the recent move that we've seen higher in yields. Obviously, with yields on the move, it's been impacting high multiple growth in tech stocks, and now the question becomes, is this truly transitory in nature? Or due to the vaccine, will we have widespread inoculation and a perhaps overheated reopening of the economy that leads to a more sustained move? What I wanted to do in this video was illustrate some similarities that I'm now seeing as evident based on the relative rotation graph analysis compared to a previous instance in which we had already seen yields moving up, but then as they begin to pressure resistance, we saw equity markets fall under pressure. And that previous instance was October of 2008. And if I take you back to a Market Watch article from October of 2008, you'll notice 3 reasons why U.S. government bond yields are soaring, and they of course cited extraordinary growth potential. Quote, most investors pointed the finger at improving economic prospects after the Institute of Supply Management Services gauge logged its second highest reading in its history, potentially raising expectations for gross domestic product growth in the third and fourth quarters. Well, if you'll notice, as evident on this chart, we had already seen a fairly significant move from about 1.34% clear all the way up to 3.25%. And initially on this move up, we challenged previous price extremes that had acted as support previously and flipped to turn as resistance starting at about the 2.9% level. But as we broke through that resistance, which, by the way, if we take a look at a decline off of the 2007 through 2012 move in yields, happened to be about a 61% retracement, kind of similar to what we're seeing here. So as we get the move up from September 2nd through October 7th in the 10-year, if I take you over to a chart of the S&P 500, you'll notice that going back to the move here in 2018, here's your January market top, your sideways consolidation in the form of an Elliott wave triangle, your move up to 2940.91 intraday S&P high. And so here's your September move. Markets move up into the 2nd of October, and then the markets get pretty much hammered through the 29th. Going back to the chart here in yields, you'll notice as we broke through that previous resistance area, which started to concern the markets, as it was a zone which we expected to hold as resistance, we move up and we see a top on about November 7th. Okay, so back over to the S&P. On the 7th, we had already started our decline. Here at about the 29th, we have a B wave retracement. Then we have the move down into December 24th low. Okay, so here we are once again where yields have been pretty much on the move consistently since August of last year. And looking at the S&P, if I take you over to the move from August of last year, we've been on a continued, well-sustained uptrend. As we broke into resistance, we started to see a bit of a corrective pullback. In fact, the corrective pullback here in the S&P we had anticipated, it since yielded a move to new highs. The NASDAQ saw a more significant market sell-off, but it too has already had a fairly decent retracement. Okay, so let's take a look now at what we were seeing based on relative rotation graph analysis and how this entire move fit in with the move higher and through resistance in yields, which, by the way, that's what we're seeing here now once again. Taking you over to Optima, I first want to show you the weekly relative rotation of the 5 sectors. We're going to look at the XLF, the XLB, the XLI, the XLY, and the XLK. That's financials, industrials, materials, discretionary, and technology. We're comparing this to the broader S&P, so the benchmark is the S&P. And you'll notice here we had technology in the leading quadrant. We had discretionary attempting a move into leading. So we have northeast headings on tech, not quite northeast, more northwest on discretionary, kind of southwest on financials, and southwest on materials and industrials. This is February 5th of this year. We then get a very sharp pivot in which we see financials now moving northeast. We see industrials still with a westbound direction but moving more north. Same with materials. But discretionary and technology made a fairly significant reversal. You'll notice as soon as the XLK made its hook, the trend algo, which is built into the logic of the RRG package inside of Optima, indicated a return to the weakening quadrant. We then see that dynamic continue, and now we have, at the end of last week, discretionary and technology both inside of the lagging quadrant. As we were moving into the lagging quadrant, industrials, materials, and financials all attempting northeast headings. To start the week, however, we now have technology with a fairly sharp hook that is attempting to form, while discretionary hasn't quite printed that. Down to the daily chart, you'll notice here on the daily, we had materials, industrials, and financials leading while tech and discretionary were southwest bound inside of the lagging quadrant. And then we have this hook. We're now seeing a gain in relative strength and momentum in technology and discretionary, and a loss of relative strength and momentum in materials, industrials, and financials. Now, interesting dynamic at play here with the sector spiders relative to the S&P. Let's now take a look at what we're seeing in value versus growth. If I take you over to value versus growth, you'll notice that over here, the IVW growth ETF was in the leading quadrant in April of last year. Okay. It pretty much remained there, leading the S&P, and value was lagging. We got to move up in value. So here is January 15th of 2021. Value now leading, growth now lagging, northeast, southwest. Then you have this pivot. We see a convergence of value with a southwest heading. This is more northeast, pretty much south and north, however. Then we see a fairly significant hook and reversal. We now have the IVE value ETF pivoting off the 100 line and moving back into the leading, and we have growth rejecting just shy of the 100 line and moving continued into lagging. However, today, to start the week, so yesterday the 23rd, you'll see this attempted hook forming. Now, this is still an eastbound heading, and this is still technically a westbound heading. But the attempted reversals from south to north and north to south are quite interesting. And when I take you down to the daily chart, you'll notice the IVE value and the IVW growth on the daily seeing a similar reversal. We now have value moving leading to weakening and growth moving lagging to improving. This dynamic at work here on the daily is what's giving us that attempted weekly hook here, right there. Okay. Back over to the weekly sector spiders, you'll notice here on the daily, we've already got the hook on the daily, and on the weekly chart, we're seeing that attempted hook forming in tech. We're already seeing that attempted hook forming in tech. So now what I want to do is I want to take you back to 2018, because in 2018, as we saw yields move through resistance and the markets get hammered, we had a very similar instance unfold. So we're going to go back to 2018 here. And you'll notice, in fact, before I get there, I want you guys to see this. Technology discretionary back on January 29th on the weekly, attempting to move back from weakening to leading. You see the move back in tech. So tech moved back. Discretionary was on its way. The trend algo was supportive of the continuation. But then you see the reversal. Okay, so the pivot, hook, continuation. Tech actually made it back into leading. Okay. Back in 2018, however, we had a very similar situation where tech and discretionary moved into weakening. The trend algo was supportive of reversals. The reversals attempted right here, and it failed. Tech didn't even make it back into leading. And then you have tech and discretionary moving both simultaneously back into the lagging quadrant. Both are now with southwest headings. This is 11:23. When tech finally makes its hook, right about there, that'd be the real first true hook attempt. Maybe you could call it that. This was 12:14. 12:14. Okay, so let's go back to 12:14 on the charts. And you'll notice, looking at the NDX, on 12:14, we were right here. Right there. So we did proceed slightly lower, but we eventually resolved the higher degree trend. Now, let's take a look. I hope you're seeing the similarities here between what's at play back in 2018 versus what's at play now. Let's now look at a side-by-side comparison of the daily RRG of then versus now to try to attempt to substantiate this return to favor for growth stocks. Side-by-side comparison on the left, we have the current day's movement where we have discretionary and technology that have both made a pivot and rotation from lagging back here into improving. The TNX, the 10-year yield, coming out of leading relative to the S&P, weakening relative to the S&P. Here we are back in 2018. Notice tech and discretionary both coming out of improving, attempting to rotate back, or excuse me, out of lagging, attempting to rotate back into improving, while the 10-year is moving into weakening relative to the S&P. Is this instance similar to the past? I think it's very much so overdone at this point. While I do anticipate a further move higher in yields, I do expect growth in tech stocks to eventually resolve their longer-term trends. Now, notice when we just looked at the previous 2018 instance, we did have a secondary continuation lower, but it ultimately resolved into the higher degree trend. Okay, last but not least, value versus growth, then versus now. Here we are on the daily chart. You'll notice back in 2018, obviously a more significant differential at play now. But back in 2018, on the daily, as we saw growth or value move back to weakening, we saw growth move from lagging to improving. Here we are today, as we see value move from leading to weakening, growth is moving back from lagging to improving. Where we go from here, yet to be determined. I do like the similarities between these two moves. I'm going to continue to track this dynamic. We'll see where it takes us. Last but not least, I want to take a look at the 10-year wave count versus the TLT wave count. Here in TLT, you have the move down in A, 3 waves back in B to a 78.6% retracement. In the 10-year count, we have a move up in 1 or A, 3 waves down in B or 2. Then you have 1, 2, 1, 2, 1, 2. And here's your characteristic, very typical of a third, and over to the TLT, 1, 2, squares up to that 1, 2. There's your green 1, 2. There's your orange 1, 2, and here's your more significant decline. This calls for 3, 4, 3, 4, and a final move lower in 5. This also calls for 3, 4, 3, 4, a final move higher in 5. Could even take us up to 2.5 to 3%. So we've got to keep our eyes on this. Okay. All right. That's it for me today. Hope you enjoyed the video. Questions, comments, concerns, you know where to reach us. You can visit us at any time, tradinganalysis.com. Hope to see you guys bright and early, 8:45 Eastern on Todd Gordon's YouTube channel every Wednesday for our TA Live Wednesday show. Have a good one, traders, investors. Let's keep our eyes on the move in treasuries. Let's keep our eyes on the markets. And we'll catch you on the next video. Take care.